Hey everyone, and welcome to the AI Tech channel. Are you ready for a potential shocker? Nvidia, the undisputed king of AI chips, might be about to give some surprisingly conservative guidance. Now, before you panic and sell all your stock, hear me out. This could be a brilliant strategic play, not a sign of weakness. We're going to dive deep into the under-the-radar reason behind this potential move and what it means for the future of AI investment. Buckle up, because this is going to be a wild ride. All right, let's set the stage. Nvidia's earnings are always a huge deal. The market is practically addicted to their consistent beat-and-raise performance. For the last year and a half, they've crushed expectations quarter after quarter. But the days of those massive surprises might be coming to an end. The market has changed. Demand is better understood now, and the whisper numbers are getting closer to reality. Think of it like this. The low-hanging fruit has already been picked. Now, it's time for the real work. That's why conservative guidance might be a strategic move. Before we get too deep into Nvidia, let's zoom out and look at the broader economic picture. We're expecting ongoing sequential quarterly slowdowns. The economy is slowing every quarter, and we don't expect it to bottom out until the third quarter of 2025. But here's the kicker. We're still holding on to our no recession forecast. That's right, we're cautiously optimistic. But a period of government belt-tightening could act as a headwind for the market and for earnings growth. This could be one factor influencing Nvidia's outlook. They're smart. They see the same macro trends we do. And what about inflation? The Fed's favorite measure, the PCE, is coming out this week. The market's not expecting a cut to the federal funds rate until June at the earliest, and even then, it's only a 50-50 probability. The tailwinds that really impacted the market last year are starting to recede. Inflation is moderating, but at a much slower rate than expected. Relatively high valuations and these slowing tailwinds could mean the market won't make that much more ground over the near term. We're probably bouncing up against the top of the range for the next quarter or two, until we see earnings acceleration later this year. Nvidia is factoring all this in. They are not living in a bubble. Now, let's get back to Nvidia. What specific questions should we be asking during their earnings call? Well, I highly suggest checking out the pre-earnings note published by Brian Colello, the Morningstar technology strategist who covers the company. He is a genius. He highlights several key areas. First, what percentage of AI workloads are training versus inference? Nvidia dominates the training side, but only 40% of its GPUs are used for inference. This is crucial because inference is where the long-term growth lies. Also, how much of the development of large language models is going on in the cloud versus at the edge? Finally, what percentage or what volume is Nvidia seeing from consumers who are using their AI for moonshot projects, like genetics, drug discovery, robotics, and autonomous driving? These are the fundamentals that will inform our estimates going forward. From a valuation perspective, heading into earnings, how does the stock look? Interestingly, the stock price is relatively flat compared to when it reported last quarter. Is the momentum fading? Last year, institutional portfolio managers had to have at least a market weight in Nvidia just to keep up with the broad market gains. Maybe that's not the case in 2025. At around $134 per share, it's almost right on top of our $130 estimate, putting it right on that 3-star territory. So, it's not screaming buy, but it's not screaming sell either. It's a wait-and-see situation. Think of it like Walmart. They recently reported solid results, but offered conservative guidance, and the stock fell. Why? Because the market expects continued rapid growth, but that growth might be slowing down. Walmart benefited from the change in consumer spending patterns during high inflation. But longer term, we expect spending patterns to normalize. Nvidia might be facing a similar situation. The short-term boom might not last forever. They are planning for the long game. On the other hand, look at Hasbro. Their stock popped after reporting earnings. Why? Because they exited low-margin brands and are now focused on higher-margin products. The market liked that. They are returning to top-line growth this year. Nvidia is in a different position, but the key takeaway is that the market rewards companies that have a clear strategy and a path to sustainable growth. Nvidia's guidance is not the whole story. Consider Gilead Sciences. The stock was up after earnings, and Morningstar raised its fair value estimate. The results were better than expected, and the guidance for the year was better than expected as well. A potential launch of their 6-month injectable drug for HIV prevention later this year could be a catalyst for the stock. The stock is up over 60% since recommendation. Nvidia has already had its big run, so now it's about sustained performance, not just explosive growth. Or take Medtronic. The stock pulled back a bit after earnings on slower than expected top-line growth, but it rebounded thereafter. It pays a 3.1% dividend, so at least you're getting paid a reasonable rate while you wait. Stocks at a 20% discount. It's enough to put it in that 4-star range. The company is buying back stock. Nvidia is also strategically deploying capital. They are not going to make rash decisions. Finally, let's look at Baxter International. The stock was up after the company posted solid results and issued a pretty good forecast. But we have a poor capital allocation rating on this stock. Why? Because of relatively weak execution during the 2022 and 2023 inflationary period, some bad pricing decisions, and a relatively weak balance sheet. The sudden departure of the CEO might be related. Nvidia, on the other hand, is known for its strong leadership and careful capital allocation. They are not going to make the same mistakes as Baxter. So, what's the under-the-radar reason behind Nvidia's potentially conservative guidance? I think it's a combination of factors. First, they want to manage expectations. After a year and a half of crushing it, they can't keep up that pace forever. Second, they want to be realistic about the economic environment. The economy is slowing down, and inflation is still a concern. Third, they want to focus on long-term sustainable growth, not just short-term gains. Fourth, the B200 Blackwell architecture is coming, so some customers may pause purchasing to evaluate. Finally, they want to be prepared for any unexpected challenges or opportunities that may arise. In short, they are playing chess, not checkers, and they are thinking several moves ahead. But here's the real bombshell. This conservative guidance could be a brilliant strategic play to solidify Nvidia's dominance in the AI market. By setting expectations lower, they can more easily beat them in the future. This will keep investors happy and maintain their stock price. It also allows them to focus on innovation and development without the pressure of constantly having to deliver blockbuster results. It is a way to prevent competitors from gaining ground. Finally, it sends a message to the market that Nvidia is a mature, responsible company that is focused on long-term value creation. So what does all this mean for the future of AI investment? I think it means that we're entering a new phase. The days of easy money are over. Now, it's time to be selective and focus on companies that have a clear strategy, strong fundamentals, and a proven track record. Nvidia is still a great company, but it's not a slam dunk anymore. You need to do your research and understand the risks and rewards. And remember, don't panic if they give conservative guidance. It could be the smartest thing they ever do. All right, that's all for today's episode. What do you think about Nvidia's potential conservative guidance? Do you think it's a sign of weakness or a brilliant strategic play? Let me know in the comments below. Also, don't forget to like this video and subscribe to the AI Tech channel for more in-depth analysis of the AI market. And as always, thanks for watching.